the key takeaway is that valuation is subjective based on what the market wants to pay. And we have no control over what the market wants to assign as the right multiple of
So, hello to the community. I'm super excited for today's episode. It's going to be filled with tons of information for you. It's crazy. I've been on YouTube for over 2 years, and today will be the first time that I have a guest. And it's also the first episode of a new video series where I interview other investors. I want to start this series because I believe that there is no one investment style. So I want to meet with other investors and try to learn from them. Today, I will have the pleasure of talking to a great investor, one who might not know it, but has helped me boost my YouTube career. And he is also the CEO of 7 Investing. Today, I welcome Simon Erickson. Simon, thank you for being here today. And congratulations on the first birthday of 7 Investing.
Oh, thanks so much, Jose. It's an honor to be here on your show. I'm a big fan of your YouTube videos, your analysis. We have a lot of fun here. Thanks for having me.
So Simon, I mean, I know you. A lot of people on Twitter know you, but I want to say maybe some of my YouTube followers might not. So maybe we can start off with some easy questions and work our way from there. Let's begin with an introduction of yourself, Simon. What got you into investing and your why? And I think that why is super important because you are the CEO of 7 Investing. And for you to be a CEO of such a company like that, there needs to be a why for you to start it. There's something that lights you up in this investing life.
Yeah, the why was letting your money do the work for you, right? I mean, anybody who's working, how much better is it when you've got your money doing the work for you and making money for you on the side? That was always the intention of how I wanted to start as an investor. I was a sales rep for General Electric through my 20s. And so I was always out on the road, shaking hands, racking up frequent flyer miles. But it was really nice to also be like, hey, I can see this money that I've saved kind of doing a lot of work for me too. And my path, a little bit of background since then, went to work for a renewable energy company, which was part of a larger oil company, which was kind of interesting. And got an MBA in entrepreneurship and worked for the Motley Fool for 7 years. And kind of along the whole path, it was always, what is the next big thing? What is the future going to hold? What's innovative out there? You want to be on the cutting edge of what's going on. And I think that the stock market is a great representation of that. And so I guess the answer to your question, the first question you asked, the why was always kind of, first, how can I get a greater return and let my money do the work for me? And then more on how can I optimize that to make it even better over time?
So Simon, I was reading your biography on 7 Investing later last night, and I saw you started off your bachelor's degree as an engineer, correct? Is that true?
That's right.
Yep. So what ended up, it's funny because I started off I'm an electrical engineer, right? That's my background as both bachelor's and master. What ended up changing you from, you started off as an engineer? When was that transition to, hey, let me go for a master's on entrepreneurship?
Yeah, I did some hard time in a chlorine production block, in the middle of Texas heat, kind of changes your opinion about a lot of things. I was a chemical engineer and Jose, so I guess we're brothers in, the engineering background on that.
Yeah.
I think that engineers, it's very methodical, right? It's very quantitative, and you're using formulas and crunching numbers all the time. And that definitely translates to a lot of the things that goes into investing as well. But then coupling that with a technical sales background where you're actually going out there and seeing why people are wanting to do things and what their organizations are. And, then you kind of got a perspective on the commercial side of it. I think that kind of investing is the layer that sits on top of both of those. We say, okay, if you've got a company that's really operational and really good at what they're doing, but then they also get like the sales and commercial side of it too, the stock market is what's going to keep score for them, right? If they're performing and churning out profits, investors are going to want a piece of that company. And that's why there's no shortcuts in investing, right? The scorecards are going to tell the tale of whether they're winning or losing.
And I just thought that was super funny to read. And Simon, we keep talking about 7 Investing. Again, there might be some of my viewers that don't know what 7 Investing. Can you give us a quick brief of 7 Investing and where one can find out more about it?
Yeah, sure. Thanks very much for the opportunity, Jose. We're 7investing.com is our website. We're at 7investing on Twitter. And we started the company, myself and my fellow advisors, really to empower people to invest in the stock market, right? We kept hearing people saying, oh, the stock market's too hard. Oh, no, it's rigged against us. Oh, I just don't even know where I would begin with something like that. And we said, we can change this. We see the compounding of wealth over time and what that has made an impact in our lives for, let's share that love of investing with others. And so what we do is every month we go out, we do the legwork, we do the research, and we find our very best ideas in the stock market. And we pull all of those together. We say, here is our 7 best ideas in the stock market for $17 a month. And it's reports. Yeah, we do recommendation reports. And then we also follow up with a look into our research process and kind of a way to interact directly with our advisors. We're having a lot of fun. We just celebrated our first birthday on March 1st.
Yeah, that's insane. It's been a full year. And I saw it's, how many countries are you guys hitting right now?
We have customers in 88 countries already.
That's insane. Completely random, but is there any country that you guys saw that we're like, oh, wow, we didn't think we were going to hit this market, or we didn't think we were going to see this type of growth in this part of the world?
Yeah, Middle East. I mean, we're not doing any marketing in United Arab Emirates and some of the countries over there in the Middle East, but they are really taken to it, which that's fantastic. Cool. I love every country, right?
So for all the viewers here, I am going to post a link on the description, and you guys should also see like links to the website over the video. So make sure to click it and check it out at 7investing.com to learn more about Simon. So Simon, let me just start off with, again, we're just going to start off with some easy questions. And then later on through this episode, they're going to get harder and harder. So first, just an overall on your investment style. So what type of companies are you looking for? And what do you do with your investments?
Well, I've got my coffee, Jose. So by the time this kicks in, I'll be ready for those harder questions at the end of the interview. Thanks for the softballs at the beginning, because I'll be ready for the hard ones. I have kind of a two-toned investment approach. One is the one that I think that people are more familiar with me as a growth style investor, an innovative investor. I'm looking for companies that are plowing their money back into R&D to take advantage of a market opportunity out there. And we kind of label that as growth style investing, right? It's companies that are investing in themselves. And then the other side that I have is more for retirement accounts that I manage, my own accounts that I manage for retirement, which is more of companies that are very stable, undervalued perpetually. They are paying a rising dividend, and I just reinvest those dividends over time too. So it's a dividend reinvestment portfolio with solid competitive advantages that are not going to fall apart easily. And so kind of with the two of those, right, you've got an offense portfolio and then a defense portfolio. It helps me sleep at night. Some of it is fun. And, you see how markets are changing. You see the innovation that's taking place. And the other part of it is almost the opposite of saying, okay, who is not going to be disrupted out there? And you want to hold on to that. And I want to hold on to those for decades.
And you mentioned it perfectly. You have like an offense and a defense. Has it always been that style for you, or has it changed over time?
It started actually with probably just the defense portfolio, right? I started as an investor just kind of learning about competitive advantages and learning about things like return on invested capital and how companies could maximize margins and increase their profitability over time, lock out competitors. What changed was cloud computing and various other innovations are really actively trying to disrupt those types of companies, right? It's so easy now to get a business up and running or create an app right now or get something spun up that used to take a lot of capital investment.
Definitely.
And you have to be mindful of that and really see what's going on out there, because it's not enough to just say, okay, we're going to go after our large customers. We're going to improve our profit margins from 40% to 50% to 60%. Like, if you're going to do that, you better be investing in research and development, and you better be in tune with what's going on in the market. Otherwise, you're going to become a dinosaur in your industry that's going to be forgotten about.
Definitely. And that's super cool, right? Because I feel like young investors, especially investors when starting off, I was one when I first started. I used to just focus on one investing style. I used to believe that, hey, especially when I first started off, I would just look at like PE ratios and stuff and certain metrics, and that's what everybody would talk about. And over time, I've kind of developed where there's no one investing style. And like you mentioned, you can be a growth investor, and at the same time, you can also be a defensive investor. And I feel like that's such a great point that many viewers should kind of grab, that there's no one style. Obviously, a PE investor or a defense investor can do great. A growth investor can do great. And a mixture of both can also do great. So definitely thanks for sharing that.
And capital allocation too, Jose. I mean, something else that, I think that better defines the type of company you're investing in rather than saying, oh, definitely a growth investor or definitely a value investor. I mean, it kind of comes back to how is the company that you're investing in using its own money that it's creating, right? Are they sharing it out because they have no internal opportunities to grow, paying a dividend? That might
Definitely.
be kind of more of a conservative type of investing for somebody that's in retirement or needs that income being paid as a dividend, versus are you willing to wait 10 years, maybe more than that, and take a bet on a company like a Tesla out there that is just, a couple of years ago, Tesla's profitable now. They're turning out profits now.
Definitely.
Now.
Yeah.
But you remember a couple of years ago, I mean, people were thinking that Elon was going to go bankrupt.
Yeah. I mean, even he said it. He was like I forget, a few weeks from going bankrupt too. So, I mean, it's crazy how just innovation can take you to a whole new level.
It is. And there's a place for both of those. I'm not saying that one is right or wrong either way.
Exactly.
What are you comfortable with as an investor?
So again, talking back into like the younger investors, I'm pretty sure if you can go back in time, there would be something you could share to your younger self in the form of some financial mistake you might have made in which he doesn't make it again. If you can go back in time, what would be maybe two or three things you would teach your past self about so he wouldn't make that mistake again?
Well, the first one is definitely if you're just getting started, take your time to dip your toe into the shallow end before you feel like you have to jump in. I've made some mistakes where I got real excited about a company that I didn't know that much about yet. And I put a lot of money to work before I really did my homework and really did my research. And that bit me when I didn't understand those companies very well. And then they fell in price for all the right reasons.
Definitely.
But I didn't see it at the time. I didn't do thorough enough research. And I don't think there's a single investor out there that on day one knows everything, right? You kind of gradually learn more. The more that you watch Jose's YouTube videos, you learn more and more about how to be a great investor. So make small investment mistakes at first. I think it's okay to maybe put a little bit of money to work in a company you don't fully understand. And then as you become more comfortable with them, don't feel like you need to back the truck up right from the very beginning. I guess another one that's kind of related to that is don't always believe the headlines. You see a lot of media headlines saying, oh, this is definitely a great buy. Oh, it was a great quarter. Oh, they beat earnings. Oh, look how great things are going. I think it's healthy to be a little more skeptical of the talking heads that we see on news shows when they're describing just one quarter's earnings or one earnings beat over analyst expectations. That's a great data point, but a lot of times there's a lot more going on that you don't see in those 30-second clips that fly by on the news. Yeah. And so maybe be more thorough and kind of dig into not just the press releases for earnings results, but also presentations. You can get into 10Ks, you can go to definitive proxies. I mean, there's a lot of material.
Definitely.
Tells a much more thorough, clear story. And then the biggest one of all is don't sell your winners. It's so tempting when you have a company go up twice in value, 100% gain.
Yeah.
You just want to say, oh, I'm ready to take that money off the table. Go take a vacation or do whatever you want to with the profits that you've made. But the greatest companies will continue to compound. They will continue to find ways to unlock value for you as a shareholder. Yeah. And so I would rather now cut an underperforming company that's not performing well on the operating metrics than a company that continues to grow, because a lot of times when you sell a top, you're missing out on several more highs.
More tops, yeah. and that's crazy. I mean, all those mistakes, I mean, it kind of hit me in the gut too, because when I first started investing, those are mistakes I've definitely got into, right? I would buy into a company that, hey, I did some research. I believe my first company that I bought might have been Disney. And it was just because they had just announced that they were buying Star Wars. And I'm such a huge Star Wars fan, Simon. So I'm like, okay, man, Star Wars is going to make them so much money. So it was the first stock I bought. Luckily, at the time, I didn't have a lot of income. And I'm like, okay, the first Star Wars movie came out. Why hasn't my stock price gone up? Then you go research the 10Q report. You go research, you see, oh, movies are such an X percentage of Disney's revenue, right? And like, okay, now if I would have seen this beforehand, I could have seen that, hey, Star Wars wasn't really going to make such a huge impact in the company's business or stuff like that. So just like you mentioned that, and the data points I thought was super important. Now data points, how you mentioned not to look at the headlines and stuff like that of news, and now with technology improving, I agree. I mean, even here with like YouTube channels like myself, right, and a lot of people on Twitter, that should also just be used as data points. You could never borrow some form of conviction from another investor, right? And I think that's really good for people to understand that, hey, yes, that's a form of data point I can use for whenever I continue to research more about the company. So those are some pretty great points. And obviously sell your winners. AMD was probably my biggest, one of my best winners when I started off. And like you mentioned, I saw it 100%. I ended up selling. If I would have kept holding on to AMD, it probably would have been one of my biggest position sizes in my portfolio. Yeah. So it's crazy.
And Jose, to give you credit too, I really enjoy your YouTube videos too, because you do kind of talk about, the headline numbers and stuff like that, but you really peel back, the second and third layer of the onion in your reports. I really enjoy your videos because it exposes investors to what's really going on with these companies. I enjoy them. They're very thorough.
Thank you, Simon. Thank you. So now we talked a bit about valuation, and I feel like that's something that even for me, I've been kind of learning, and I still believe I can learn some more. But I do believe there's so many moving parts in a company, right? Future innovation, future expansion into a new market that we can't even think about. So I believe putting some form of real value in a company is very difficult. What are some methods or metrics or styles that help you feel like you don't overpay for a company? Because even though I believe that, yes, it's very hard to put a price to a company, at the same time, I feel like we need to set some form of realistic expectations of how much a company can grow or how much is it worth at right now, where we feel comfortable paying that price for it.
Well, let me hit you with the key takeaway first, and then I'll give the research to support it second. The key takeaway is that valuation is subjective based on what the market wants to pay. And we have no control over what the market wants to assign as the right multiple of a company's fundamentals. And what I mean by that is, we can look at price to earnings multiples, we can look at price to sales multiples, price to cash flows. All of those are based off of fundamental metrics, right? You still got the company performing how it's going to perform. It's operating, it's growing revenue, it's growing earnings, growing cash flows. The market's then going to say, okay, I'll give you a valuation multiple of 10 times sales. Or maybe now it's a little bit more optimistic, 20 times sales today. Maybe it even gets up to 30 times sales, right? And it's kind of the mood of the market depending on how cheap money is, how low interest rates are, how much access institutional investors have to funds. There's a bunch of different variables, but it's still very subjective. There was a study that was conducted by Boston Consulting Group with collaboration with Morgan Stanley that looked at over a 20-year period, what are the market's best performers? So the top quartile of the S&P 500, the best performing stocks that are out there. What drives their returns over 10-year periods of time? So again, we've got high performers and long-term investing. What's at the crux of that? And they found that the correlation to valuation multiples, 5% of returns, whereas correlation to fundamentals, growth in cash flows, growth in profits, growth in revenue, 95%.
Wow, that's crazy.
So what that means is the market's going to go like this. It's going to say, okay, we're going to give a great multiple this year. We're going to give a lower multiple this year, whatever they want to do. If you're in this for the long term, you've got to find the right companies and hold on to them, because that is what's correlating. You don't want to sell your winners. You don't want to get out of great stocks. You want to hold on to them, because over the long term, it doesn't matter what the market's valuation multiples are if you're thinking in 10-year periods and can hold on that long.
Yeah, that's actually cool. And I don't know if you might have seen that. The moment you said studies, my whole face grinned. Like, I just love hearing studies and research. I don't know if it's just the engineer in me, but you were like, studies. I was like, But that is insane. That's crazy. I'm gonna have to, hopefully after this, I can bug you and take a read at that information. So we've seen, like you saw, there's software stocks that we've seen with price to sales valuation before this market correction that we've seen of like 30, over 30. And now things have pulled back. Things are kind of looking, I think they're closer to 20. I don't know the actual average, but they've definitely pulled back a nice amount. And even though with that study you mentioned that price to sales or valuation, any types of metrics only don't really account for much in the long term of things. Us being here in the present, obviously we think about long-term investment, long-term style, but we're still living here in the present. When you see valuations like we've seen in the past, before this correction expanding to like 30, does it change any of your investment styles or anything? Even though you know that studies that, hey, it doesn't really matter in the long term of things.
Well, I have two thoughts on it. The first is the bad example and maybe the good example, right? The bad example is what's happening with GameStop right now, right?
Mm-hmm.
GameStop has not changed its business whatsoever in the last 6 months. It hasn't.
Mm-hmm.
It hasn't gone out and created its own cryptocurrency. It hasn't gone out and solved quantum computing. It's still
Mm-hmm.
selling console video games. It's just that the market is obsessed with it lately. It's a thinly traded stock. You see a lot of people pouring money in. I'm sure you're familiar with the Wall Street bets and the Reddit and all of this.
Mm-hmm.
The fundamentals of the business really haven't changed. It's still losing revenue every year, year over year. And it really, really difficult business to be in. But the valuations, are getting out of hand. So I think that's a bad example of an overvalued company that still fundamentally isn't something that I would personally consider to be a great long-term investment. But then to answer the other part of your question with a good example, perhaps, is look at what's going on in cloud computing right now. Cloud computing means that rather than going out and building out all the storage and all the computing yourself in your own on-premise data center, you're now having Amazon and Microsoft do that work for you.
Yep.
Now you can have them completely host your software. And by the way, you can spin it up really, really quickly and at very, very low cost for you. So the margins are insanely high if you're building something cloud-based. But still, when you look at global IT workloads, we're at less than 5% globally of workloads that have gone to the cloud. This is a trend that's still just getting started. We've been talking a lot about it, Jose. I mean, this is an innovative trend that we've caught on to, but there's still, 10x opportunity. You consider how much this could be changing. The largest enterprises have caught on, small businesses have not yet. And so when you look at that and you think about this in terms of price to sales, price to cash flow, price to earnings, whatever multiple you want to look at, they're all backward facing, right? They're looking at the trailing 12, trailing 12 months metrics. And then you think, okay, well, wait a minute. Can we really have this increase 3x, 5x if I hold on for a couple more years? And these companies are growing at 40, 50% a year in revenue, and the margins are fantastic. I mean, when you kind of piece those together, I become less concerned about valuation of those companies because I don't think that we're anywhere near steady state yet. And even though people are saying, oh gosh, it's selling a price to sales multiple of 30 times, 30 times revenue right now, I'm saying, hey, but from my perspective, what is that denominator? What is, the engineer in me is saying the revenue is still got a long way to grow.
Definitely,
if they can sustain. Now, there's another piece of it that says, oh, can they sustain that or not? But the best in class companies can. Definitely. And those are the ones you want to find. They're going to provide that long-term performance.
Yeah. And that's cool. I mean, you mentioned, right? It's ratios kind of give you just gives you a glimpse of the past. It gives you just a picture of the past. And I feel this is something that I had very hard times at the beginning is how much weight am I putting into past information and how much weight am I putting into future information? And like you mentioned, right, some of these stocks, only 5% is the market penetration right now. These companies growing crazy levels. They're improving their cash flow margins. They're improving their all their expenses and everything like that. So it can give, okay, I can see why we're paying this type of valuation for a company that is growing at this levels, improving their margins at this levels. So that's good to hear. Sometimes it seems like it's good to understand where the market is going, what that company is doing, and where that market is going to go in the future. Is it a market that's still going to continue to grow? So like you mentioned, it's very important when investing in a company to understand what you are investing, what is the product they're doing, what is the market they're hitting, is the market that they're hitting one that's continuing to see growth and innovation. So Simon, your team is filled with how many members right now?
We have 6 advisors.
And I've seen the list of different advisors. Each of them hit different markets. Each of them come from different backgrounds. And have you grabbed any information from them? I know you're an experienced investor already, but I'm sure there's something you might have learned from some of these, from some of your teammates as well.
I can't even say enough how much I've learned from my teammates. I mean, this is the greatest part of 7 Investing is that there is a team of us that sees things very differently. And like you, Jose, I kind of think that there's no finish line to investing, right? If you're doing it right, you should always be learning something new every day. And my team challenges me, and then I challenge them on every one of our recommendations each month, right? Like we have to pitch them to each other, and we encourage kind of shooting holes in the thesis, right?
Okay, yeah.
And so that we publish those too, by the way, our team calls. but I would say that the greatest thing that I learned from them is the difference in opinions, right? So we have kind of a different thoughts about the sustainability of investment returns, right? Like if you see a company that increases 100% year over year in its stock price, some of us on the team might say, "Oh, that's a great sign of it's disrupting something. It's going to continue in the future." Others say, "Well, why is that? Is that going to revert to the mean? What is driving that? Is that a short-term blip that we need to be?" I mean, like perspectives like that are invaluable, right? Or like the other thing, like should you be pushing profit margins for a company because you want to get up to 40, 50% operating profit margins, which is great. You can use those to share with your investors, or do you want to start putting that back into R&D? I mean, and then biotech is a completely different animal than any of this, right? Because then you're looking at completely different metrics. But like, I guess that it's hard for me to answer the question, Jose. I just really appreciate that the investing is very personal. We all have different perspectives on how to do it. There's no right way or wrong way. But if you're open-minded and you can listen to the perspective of others and learn from it, rather than, some people like, I've seen so many institutional investors, they're just like, oh, this is the gospel, this is what I think, anybody who tries to poke holes in my thesis is wrong. And I hate that perspective because I feel like the market is going to be the scorecard that judges you. You don't have to have an ego about it and say, oh, I'm definitely right about things like this. Let's collectively learn about this together. Let's be open-minded to different ideas. And that will make investing more fun and improve the returns over the long term.
And you said a word there that I find, I say it all the time, and I talk about it on the Discord. I have a small Discord channel where I talk to some of the investors there. It's just having an open mind. I think that's super important. An open mind doesn't mean you have to agree with the bull thesis. It doesn't mean you have to agree with their bear thesis, but at least listen to them and try to understand why they feel like that. And it's great that you guys at Seven Investing, you guys like understand that yeah, okay, I listen, but there's still a part of me that might say otherwise, but I still understand what you're going, and investors, I think, can learn a lot from there. And definitely, I think closing your, like putting the horse race goggles on where you only see one way, I think that can end really badly. Like I mentioned, some of my first mistakes were because I was just looking at certain metrics, just because I believed that there was one investing style. So that's, I envy you that you have such a great team there. And you guys are able to discuss so much. That's actually pretty cool. So Simon, without naming any stocks, or without naming any stocks, what are some of the markets you mentioned clouding? Are there any other markets that you're super excited about right now?
Yeah, this is my 3-hour conversation here, Jose. I mean, you and I can just kind of chat over Zoom and have a beer and then talk forever about this, because I really could, and you will probably stop me, hopefully. Just to name a couple, I think that are interesting. We mentioned cloud. I think that within cloud, that the computational demands that are required for AI are becoming extreme right now, and so there's a need for keeping up with those algorithms that is
definitely
lacking. There's more demand than supply available. I think, let's see, I guess there's a huge shift from the way that people are watching TV. It's now internet connected TV instead of linear TV. And so ad budgets have gone from kind of regional programming to a la carte, over the top, if you've heard about that. And that's kind of developing this ad tech platform in the middle, and how you actually serve advertisements to the right people. There's a lot of interesting names in that space. I think that biotech is extremely inefficiently priced right now. By that, I mean there's, oh goodness, what is it? 125,000 different clinical, no, actually, I'm sorry. I think it's more like 350,000 clinical trials taking place across the world right now.
Oh, wow.
When you think about that, that's way too much to keep track of, especially since a lot of these are binary events. And so a lot of money is unsure of how to put money to work in the biotech space right now. And some of my colleagues are really on top of platforms that are compiling IP in the biotech space, which is very interesting. And so I guess just to throw, maybe that's 3 of them right there. AI is a really big one. Ad tech is a really big one. Biotech is a really big one. There are some undervalued and unappreciated winners in all of those spaces.
and there's one thing you mentioned there too. It's like, within any sector, there's multiple sectors within there. Like some people go up and it's like, Jose, are you only in tech investment? And I don't really see myself just being inside tech. Like inside tech, there's so many. You have fintech, you have e-commerce, you have gaming, you have AR, you have artificial intelligence. Again, inside clouding, there's so much in there. The infrastructure that goes into the clouding, the equipment that's needed for there, the software that's needed to run there. It's insane how when you start, again, when you just look at it in one way, you just say clouding investing, you miss out everything else that's below there. You don't peel the layers and see what other types of markets you're hitting when you do that. And it's great to hear that others share that same thought. So Simon, I think that's it for the questions I had for you. There was actually one more, but this one's more selfish for me. Like I mentioned earlier, I'm an engineer, right? And I'm currently working as an engineer. But let's say someone wants to make it or jump into the finance world. What are some advice you would give to a person that wants to make that transition?
Well, first of all, always be learning. That is definitely the best one. Is, there is a ton of information at your fingertips. Take advantage of that and watch Jose's videos, because that will definitely teach you about how to invest in stocks too. And the other thing is, like, if you want to get into finance, I mean, I think that there's kind of been a traditional finance role, which was kind of more of, you worked with a fund, you worked with a hedge fund, you worked on Wall Street, you're a sell-side analyst, something like that. And I think that we're kind of in the middle of a movement right now where we're empowering more creative roles. So the learning piece, and then all of this information being available out there. I think that our mission that we have at Seven Investing to empower people is very different than kind of the traditional finance or financial engineering role that you might have seen 10 or 15 years ago. And so maybe my advice would be is, if you are passionate about stocks, about investing, about finance in general, find a mission that resonates with you, right? Find something you really love and find something that's going to help people. It's one thing to just kind of work, behind the scenes. You can crunch some numbers. There's nothing wrong with that. But if you really want to get the most out of it, I mean, think about the bigger picture impact of what you're doing and pursue that. At least that's what led us to start this company.
Simon, thank you. I can't thank you enough. I'm pretty sure my viewers are definitely gonna enjoy this episode. I'm pretty much gonna rewatch it too. There was a lot of information we talked here. So Simon, I just want to say thank you again for giving me the time to do this interview. And again, guys, if you guys want to learn more about Simon, check out 7investing.com. All the information will be posted on the description and the link above.
Thanks very much for having me, Jose.